Welcome, everybody. My name is El Farsan. I'm the Vice President of Philanthropy at the East Bay Community Foundation. I've joined EBCF last July. So like many of you, I'm also a new member of the EBCF family, and it's exciting to get to know you all. Before we get started, I want to ask you to introduce yourselves in the chat, where your name, where you're coming from, and how you're connected to EBCF. And if there's anything that you want to share with us as well. I'm very grateful for your partnership with EBCF. I know that many of you are also part of the Professional Advisors Leadership Council. And I hope that we can continue to bring and offer you sessions like this one that can support you in your service of your clients. Today, we are super excited to introduce a former PUC member, our former board chair, and a good friend of EBCF, Jim King. He's been in the EBCF family for several decades now, and we're just super lucky to have him here with us talking to you. I'm going to do a brief introduction of Jim and then jump right into a Q&A with him. And we'll have an opportunity for you to also ask questions at the end. I want to remind everybody that this is part one of a part two series. The next session will be on October 9, where it's going to be more interactive. The idea was to do this presentation, allow you to think about the content, and then come back to us with questions that Jim would be happy to answer. Now, off to Jim. He is an expert in the field of charitable giving and financial planning. He brings a wealth of knowledge and practical insights in the field, particularly as he sat on both community foundations and nonprofit desks, as well as his role as a wealth manager. He's a certified financial planner and a registered investment advisor. He founded and operated JP King Advisors for 40 years before retiring in 2021. He's also a former EBCF board chair and a former Professional Advisor Leadership Council member, and he remains an active fundraiser for his alma mater and 2 other nonprofit organizations. And we're just super blessed and excited to have him as part of the EBCF family. Jim.
Seems like Elle froze a little bit there.
But she froze, so go ahead and jump in, okay. Jim.
Okay.
And
Thank you, Marta.
Elle, if you freeze, I'll take over.
Good afternoon, everyone, and thank you for taking time out of your busy day to meet with us and hopefully learn a little bit about what we titled the ABCs of QCDs. QCDs are Qualified Charitable Distributions. You probably have heard of. You may even have some clients who have so far availed themselves of this practice or this program. But we thought it'd be good to establish a base of knowledge and go over some of the fundamentals of, or the ABCs of QCDs as our starting point. As Elle pointed out, in a follow-up session, we'll have more time for Q&A, and actually I'll put together a little mini case study that we'll send out so that you can see where do QCDs fit in a client's possible philanthropic situation, or can assist them in meeting their philanthropic goals. So QCDs, Qualified Charitable Distributions, were established in law, Act of Congress, approximately 10 years ago. I don't remember the exact time, but they've been around for a while. But they're kind of a best kept secret. The first question that always comes up is, well, why should we have any interest in a QCD and what it is? So I'll preface that by saying QCDs this discussion is because the minimum age that a person must attain before they can do a QCD is age 70 and a half. So we're going to be talking about, that segment, that demographic of your clientele, people who are 70 and a half or will soon be 70 and a half or older. Unfortunately, no matter if they've started taking withdrawals from their IRAs or they've retired before the age of 70 and a half, it doesn't impact them. They cannot make a QCD. There are, of course, a number of other philanthropic options available for folks who haven't reached that age. But here's our target group. They're 70 and a half or older. And the second criterion is they have to have an IRA because QCDs only apply to distributions from IRAs. So it says qualified charitable distribution, meaning a distribution from an IRA. And for practical purposes, we're talking about a traditional IRA, typically an IRA rollover, not a Roth IRA. There's no sense to make a charitable contribution out of money that you can take out tax-free. That's a different discussion, but so it's a taxable IRA, typically a rollover, and that rollover could have come from a SEP. It could have come from a 401k. It could have come from a 403b or even a pension. So it doesn't make any difference where it came from, but at the time of making a QCD, it can only be made from an IRA, and typically an IRA rollover, because by the time someone gets to 70 and a half, they may or may not be making contributory IRAs, but most, in 99% of the cases, they have an IRA rollover. And it could have been a traditional, contributory IRA, could have come from a 401k, as I said, could have come from anywhere. All right, so here's your client, 70 and a half, 71, whatever, they're over 70 and a half. And in discussing why they should make a contribution, I look at it in the broader context of, well, what are you going to do with that IRA? At a certain point, now the age is 73. Back some years ago when the QCD was first set up, it was 70 and a half. It was the same age as when required minimum distributions, or RMDs, began. That's been changed by the Secure Act, and most recently Secure Act 2.0, which has now bumped that RMD age, required beginning date, RBD, up to 73. So there is this little 2.5-year gap now. Someone may not have an RMD, but they've reached 70 and a half, so they can make a QCD. Now, why would they do that? Well, what can you do with an IRA? At some point, you have to take distributions. Well, what are you going to do with those distributions? Well, number one, obviously, people take distributions to supplement their lifestyle. But to do that, of course, this wonderful vehicle that when you put money in, you got a tax deduction, it grew tax deferred. But now, when that money comes out, what happens? It gets taxed at your highest marginal tax bracket because it comes on top of any other income you may have. And there's no it's not like capital gains where you have a cost basis. This has a zero cost basis. 100% of that distribution is going to be taxable at the client's highest marginal tax bracket, whether that's 24, 32, or 35, or 37, or whatever it might be. So, okay, fine. I want to take a distribution. I want to end up with $10,000, but boy, in California, depending on the state, because it's going to be taxable for the state as the feds, maybe I've got to take out 17 or 18,000 just to get my 10,000 after tax. So it's a required minimum distribution. Any kind of taxable distribution from an IRA is very tax inefficient. It's about as inefficient as, because it's fully taxable. The only thing that's worse, if you will, is wages, because then you got to pay Social Security and Medicare out of that too, which you don't have to do out of an IRA distribution, but you do have to pay full ordinary income tax. Well, the other option you have once you reach age 70 and a half is if you want to make a charitable contribution and you have a philanthropic intent, the most tax efficient way to make that contribution or that donation is by doing a QCD. Because as I just said, why? It has zero cost basis. Now, even if you bought a stock or you started a company and its cost basis, it's gone up 10 times. Well, you still have 10% of whatever you give is that's after-tax dollars. Now, you may get a deduction for the 90%, you may get a deduction for 100%, but you still have a net after-tax cost of making that contribution or that donation. With a QCD, zero. So the why is two objectives can be satisfied. Number one, of course, is your philanthropic objective. But number two is the most tax-effective way to make that contribution. So that's the why.
Really helpful, Jim. Are there any questions before he digs deeper? You're certainly welcome to put questions in the chat or raise your hand and come off mute. Jim, I know a number of our fund advisors are always asking about dollar limits and what their restrictions are within a year or within their lifetime.
Good question, of course. So the qualifications, if you will, we already talked about that. You have to be 70 and a half. You got to have an IRA rollover. How much can you give? The dollar limit was recently raised from 100,000, which is what it was originally set at, as I say, approximately 10 years ago. It's now $105,000. And in fact, in the Secure Act 2.0, it was indexed to inflation. And that's why it bumped up the $5,000. So in fact, some of the websites that we'll reference you to, they haven't all fully caught up with that. Some of them will still say $100,000, but it is 105. Now, what are the chances you're going to have clients who want to exceed that? Well, not too many people want to exceed that. Remember, a married couple, if each has an IRA, could do as much as twice that, $210,000. That's the annual limit. Okay, and QCDs are an annual matter. That is to say, unlike a gift of charitable assets, which could be cash or could be securities, that you then take as a deduction under the charity, itemized deduction allowance. There are limitations in that case also as a percentage of adjusted gross income. However, it is also possible to carry forward excess contributions or deductions for up to an additional 5 years. That's not the case with the QCD. The QCD is year by year. 105,000 is the limit. Now, you don't have to give 105,000. You can give any amount up to that amount. So it's pretty straightforward as far as that goes.
And I'm curious if you could talk to us a little bit about itemized deductions and QCDs.
Sure.
The taxes.
That's a good question to raise because in order to, there are certain dollar limits, fairly modest, that a person who does not itemize their deductions can take as a charitable deduction. It's in the hundreds of dollars. It's a relatively modest amount. But for our clients of greater means who want to make a charitable contribution of, say, a few $1,000s or tens of thousands of dollars, they have to itemize their deductions. And that's not the case, however, with a QCD. So with a fairly generous standard deduction that's currently available, it's going to end at the end of 2025. Who knows what's going to happen, with the whole tax laws then. But a person who, let's say, wanted to make a donation, a charitable contribution, let's say to EBCF for, let's say, a couple $1,000s, but they did not have enough other itemized deductions to itemize as opposed to using the standard deduction. As I said a moment ago, well, you're kind of in a difficult situation if you don't have the opportunity or the option to do a QCD, because you have to itemize. But gee, if even if I want to give $2,000, $3,000, or $4,000 or $5,000 to a charity, if I don't have enough other deductions, I may be better off taking the standard deduction, which now for a married couple, I think is up to $28,000, $29,000. It's a pretty good sized number compared to what it was previously. So I'm in a quandary now. What do I do? Well, But the nice thing is with the QCD, you can use the standard deduction and the QCD. You don't have to itemize to use the QCD. Why? Because the QCD comes directly off the line on your tax return that says distributions from retirement plans, including IRAs. So if I want to take a $5,000 distribution and I'm old enough to qualify for QCD and I want that to go to East Bay Community Foundation or wherever, I don't have to itemize my deductions. That comes right off. I think it's line 4 or 5. It's right near the top of your 1040. And then the net taxable or net amount that is used then in computing your adjusted gross income is 0. Or if you're older and you have required distribution, let's say your required minimum distribution is $10,000, you want to give $5,000. So you're going to show $10,000 as your distribution, and then you're going to show $5,000 that went to a QCD. The net, what's the net taxable amount? $5,000. It's the 10 less the 5. You do not have to itemize to enjoy that. So again, for people who are sort of in the level where they would otherwise be better off using a standard deduction, the QCD is a great option for contributions or distributions in that range. And obviously, especially if they have a required distribution, they've got to take so much money out depending on their age.
I'm wondering, are there any other considerations that our clients might want to take into consideration regarding their required minimum distribution?
Absolutely. Let me make one final comment on the previous point, which is there's no lifetime limit on QCDs. As I said earlier, it's a year by year determination. And I mean, if someone theoretically lives to 100, they can make, in aggregate, and they have substantial resources. I mean, what's that? 30 years times 100,000 a year. What's that? $3 million. I mean, QCDs can add up. There's no lifetime limit. So, and you're not obligated to make year by year either. You can make one a particular year and then not make one the next year. So it's truly each year is considered independently. Okay, let's go to your next question, Marta, which was
the impact
anything else about
on RMDs, required minimum distribution.
Okay, yeah, and once again, that will apply to your clients who will be 73 or older this year, 2024. Actually, I think it may have applied last year, but last year's over. Although theoretically, a person could amend their return and make a QC. No, you have to make the QCD by the end of the tax year. So you would have had to have made that by December 31st of 2023 in order to claim it as a 2023 deduction or offset, if you will. You can't go back now and amend your return and do that. Okay, so starting this year, 2024, any of your clients who have reached age 73, the required beginning date, RBD, so they have to take a required minimum distribution. So how much of that could a person use to make a QCD? Or by the way, multiple QCDs. You can make, there's no limit, 10, 15, 20. And there is no dollar minimum. You can make a $50 QCD if you want to. Not necessarily the most effective way, especially if you're making a lot of them. There are probably better ways to meet your philanthropic objective. But let's say, as I say, for an example, a person has an RMD of, let's say, $20,000. Well, that means since your RMD at age 73 is approximately 4% of the value of your IRA rollover as of the end of the previous year. So 4%, 25 times 20,000, $500,000. So somebody who's got a $500,000 IRA rollover, 4% of that would be $20,000, and that would be their RMD for this year. Now, that you would have 3 possible scenarios. One is, or more, but 3 basic ones. One is you take your 20,000 before you take your full, well, that would be one, obviously. You just take your 20,000, you pay your tax on it, and you keep the difference. But let's say you would like to make a $10,000 QCD. Fine. Or any amount, as I say, let's say up to that 20,000, you're going to be using that to offset your required minimum distribution. So if you have an RMD of 20,000, you make QCDs of 20,000, you end up with zero going down to your adjusted gross income. But wait, Jim, you said the dollar limit is 105,000. What if I've got enough that I can give more than my required because I really don't need any money from my IRA to support my lifestyle. And in fact, I've got surplus that I've sort of earmarked in my mind for charity anyway, maybe when I die as part of a legacy. You're not limited to your RMD for QCDs. There's the dollar limit of 105,000, but a person can give more than their RMD and take the extra as a deduction. So RMD is 20,000, QCD is 30,000. Basically, you end up with a quote negative 10,000. You end up getting to get an extra 10,000 as if it were an itemized deduction. But again, it's not an itemized deduction. It is simply an offset to your otherwise taxable income. Now, I have to say, I've never had a client who wanted to do a QCD for more than their RMD. But it's theoretically possible. Let me put it that way. But I myself, my wife and I, I'm 78 years old, so I've been doing this for several years now. And every year, when I started, RMD was at age 70 and a half. So this will be our 8th year, I guess, doing it. And we don't give more than our RMDs, but we make QCDs to several of the charities that we want to benefit. And that is a substantial offset to our RMDs. So once again, it reduces us, and we're in one of those higher tax brackets. So, we get a substantial tax benefit by reducing our adjusted gross income using QCDs.
Thank you. We have a question from Aaron of, is it possible to do a QCD for 110,000 above the 105,000 limit?
To my not, now I should say right up front, I'm not a CPA. I'm not a tax expert. I was a certified financial planner. You have to be active. So I'm a former certified financial planner for nearly 40 years. And I did a lot of tax planning with my clients over the years, and particularly because of my involvement with EBCF. I was on the board for 9 years, and from 1998 to 2007. And I have worked with other nonprofits as well. So although I not be falsely modest, I am knowledgeable in this area. Please do not rely on anything I say as definitive tax advice. Definitive tax advice, you need to go to a tax professional for that, CPA or other tax professional. Okay, my understanding is the dollar limit of 105,000, it's a per person limit. So in order to exceed that, to do 110,000, you'd have to have a married couple, and each one would have to have an IRA. You cannot exceed the 105,000 out of one person's IRA or IRAs. Hope that answers the question.
Yes, that was helpful. Thank you.
Mm-hmm.
You reminded me, Jim, that you have a unique experience of sitting on both sides of the desk as the client and the advisor. And so I'm curious now, as a retiree, as someone who's 78 and has been using QCDs for 8 years, what do you know now that the folks in this Zoom would benefit from, that perhaps you would have shared with your clients before you retired, that now you have sort of a new lens, a new perspective?
Sure. Well, certainly when QCDs first came out, which, as I say, was maybe a couple years before I started qualifying for them, I simply was not versed in the mechanics. And we'll get to that question in a minute too. So how do I make a QCD? And in fact, even my first couple of years, to make a QCD was a bit more laborious. than it now is, which again, I'll explain a little more in a moment. I think, and also because of my experience with EBCF and other philanthropic organizations, I was really focused on the more traditional ways of giving, donating appreciated securities, and particularly using a donor advised fund, which I have established at EBCF. And with my clients, using both EBCF, but also Schwab and Fidelity as charitable vehicles. So, and QCDs didn't get much press or much promotion at that time. Because again, it was a new concept for most advisors, as obviously for clients. So I guess what I've learned is that it's a lot easier than I initially thought it would be, and that it's very flexible. It's complementary to the other philanthropic tools that we used and continue to use. I mean, again, I still have my donor advised fund. I make contributions to that every year using appreciated securities. Because remember, your contribution or distribution, a QCD, Qualified Charitable Distribution, when that money goes out, it has to be in cash. So it's coming out of your IRA. And if your IRA is invested typically in a range of marketable securities, you have to sell something. You have to liquidate it in order to generate cash, because the money that goes to the charity has to come to them in the form of cash. And in my case, for example, I write checks, and I'll explain how I do that in a moment. So there's no, as we know, there's no distinction within an IRA of the tax treatment of a long-term capital asset, a income-bearing or interest-generating asset, short-term gains, long-term gains, ordinary. It's all treated the same within an IRA. So, to some extent, that is a portfolio management opportunity to say, okay, maybe I should concentrate some of my tax liability type investments, income generating interest and dividend distributions, in my IRA, and then have my growth investments in my family trust, my personal portfolio, so that I can take advantage of capital gains treatment. Not only should I want to liquidate them, but also if I want to gift them, because now I'm going to get that tax benefit of gifting an appreciated security, appreciated asset, out of my family trust into a donor advised fund, for example, and not have to pay any tax on that. So I'm trying to maximize my tax benefits. QCDs, as I say, they got to come out in the form of cash. So even whatever character they might have had within the IRA, that gets changed over into cash.
It's a nice segue to the question of what sort of charities are eligible for QCD gifts.
Mm-hmm. Yeah, that's pretty straightforward because, again, this is a, quote, qualified charitable distribution. So what kind of charity? Typically, it's your classic 501c3. So this cannot go to a political party. It can't go to any kind of GoFundMe page or these types of, if you want to think of them as charitable or quasi-charitable. No, the organization to which the distribution goes must be a typical 501c3 qualified charity under IRS rules. And there are lots of them, and lots of very needy and qualified and deserving charities. So there's no dearth of need and of benefit that that you can contribute toward with a QCD.
And for clarification, QCDs can't go into DAF. They would be two different charitable tools.
Yes. Thank you I wanted to bring that. I'm glad you did, Marta, because I think that's really frustrating. And I think I remember right at the very beginning, because I had a DAF at EBCF, and I wanted to do a QCD into my DAF. No, not allowed. And maybe someday we'll get enough pressure on Capitol Hill to amend that, because. But you can see that the idea behind a QCD is a current gift. The idea behind a DAF is a current gift, but one that then can be distributed out over a period of several years thereafter. So in that sense, yes, and in fact, that brings up another point, which is if a client has a large capital event or is in anticipation of a large capital event, the sale of a business, the sale of real estate, some other substantial capital gain, there might be the opportunity to, but the donor or the owner doesn't like the idea of making a large gift. In fact, can't exceed 105,000 in a given year. Perfect opportunity for a donor advised fund, because the DAF can accept a large gift, $1 million, $500,000, whatever it might be, and then the donor, of course, can make the gifts out of the DAF on an annual basis over an extended period of time. I've done that. I've had many clients do that. That's the perfect use of the DAF, and you really can't use a QCD for that type of gift.
Thank you. We have a hand raised by L.
Yes. Well, I wanted to, offer some thoughts, and I hope you can hear me well. I keep getting notifications that my internet is unstable. One of the ways that, we would be happy to support you in doing your QCDs, if you have a client who wants to make a distribution, doesn't know who to make that distribution to, you have all the EBCF philanthropic advisors here at your disposal to give you that advice and support you and your client in making, a decision on who to give that gift to. Just reach out to us. We'll be happy to support you in that stewardship. Most importantly, we want to make sure that this vehicle is at your disposal so that you can support your client to the best extent possible. Don't worry about where that money goes. We can help you with that. Whether, like we said, you don't have to have a DAF at EBCF. QCDs don't anyway qualify for a DAF, but we're happy to give you that support to find a partner.
Let me just piggyback on what Elle has just said, because remember, think in terms of what your ultimate purpose is or what the client's ultimate purpose is. I mean, use myself again as an example. There's A, B, C, D, E, F, G organizations I want to benefit. Or maybe, in my case, because I'm in this world, I'm pretty specific. I pretty much know. But so many of my clients, and I'm sure yours too, they have a general area they want to support. Let's say they want to support early childhood education. They want to support the low-income housing, whatever it might be. But they don't have the expertise. They don't have the knowledge. And they're still working, or they have other things that they want to allocate their time to. Here's where a donor services advocate at EBCF, that's not the right name, donor services advisor, right? Okay, donor services advisor, can play the role that Elle just described. And the ultimate goal, which is to benefit our community and the nonprofits that are working in our community, is achieved. So I want to emphasize what Elle just said. Look upon EBCF not just as a place to house a donor advised fund or a supporting organization or some other philanthropic vehicle, but as a resource for you and your clients to achieve the ultimate objectives of benefiting the community. Okay, I think there was one more question we wanted to address, Marta, was the how.
Exactly.
So as I've sort of implied along the way, in the early days, the holder of the IRA, the trustee, the custodian actually of the IRA, they were learning their way with this too. So the client or the advisor helping the client would have to go to the custodian and say, okay, the client wants to send this money out of the account to ABC nonprofit, EBCF nonprofit. Okay, how do we do that? Well, it was a bit cumbersome. Of course, something which is still true is you have to create cash in the account. So that usually involves selling something. So Schwab account, Fidelity account, Vanguard account. You have to sell a security to create the cash. But then you would have to send a form to one of those organizations saying, okay, here's the address, send it, wire transfer or check. You had to choose that. And so you had this third party involvement that was just a bit cumbersome. Now, the last few years, I don't know, this was more a change on the part, I think, of the custodians themselves. They said, okay, look, we're going to give you a checkbook for your IRA. You can write the checks directly out of your IRA and send them directly to the charity that you want to. So I'm going to show you, find it here. I have my little, I'll get in the right place here, my little checkbook, checks. And, they have my name. And if I can get the, back here toward my face. Okay. Anyway, just like a regular checkbook that you'd get at the bank, I can write my checks, and I keep a little log of, who I wrote a check to. Now, I do have to make sure that I've got cash in the account, but it's that simple. You can write a check, send it off to the charity, done. But you do have to keep track of it. Now, Schwab keeps track of all the checks I write out of that account anyway, and I can look them up. So it's all digitally recorded. The only thing you don't want to do, obviously, is you don't want to write a check and you don't have cash in the account. But by the way, that hasn't happened to me, but that did happen to one of my clients. And so Schwab said, okay, we can't process the check. Fine. We went back, created cash, resubmitted the same check, and it cleared. So it's not terribly complicated. And even if there's a bit of a mess up, you can easily correct it.
A follow-up question on that, Jim, is the check the only way for people to make those gifts?
Good point, Elle. You can still do a wire transfer if you prefer. Now, you will have to involve the custodian. You'll have to just order, give whatever their procedure is. You say, I want you to wire transfer money. And maybe if you're getting up close to the end of the year or something, and you're in a big hurry, or there's some matching program that they have to have the money by a certain date in order to qualify for the match, you might want to do a wire transfer. You will have to involve the custodian in that. So those would be the two primary ways: a wire transfer from the custodian, or you write the checks, or you could just do it the way it was done at the beginning of the program, which is you just tell the custodian, please send a check. But then you have to give them the address, and it takes longer. It's more cumbersome. You're dealing with their back office, the custodian's back office. So as I say, for us, we write checks.
Right.
Very simple.
And I want to share with the audience today that at EBCF, we generally receive those QCDs like literally a day or two before the end of the year via wire transfer. And a lot of times when, like, even fund holders at EBCF who have DAFs at EBCF, they want to make a QCD transfer, we make sure that we ask that question if this is a QCD distribution or not. And then if it is, we tell them it doesn't qualify to be deposited in a DAF, and then we help them, figure out which charity they would like to make that gift to, or if they would like to make that gift to EBCF's grant making program, which then allows us to give that money back into the community. All of these options are available to you. We have another question in the chat. Do you have to inform the custodian that this is a QCD?
Well, if you are making the distribution out of your, the short answer is no. Why? Because you're going to get a 5498, or your client's going to get the IRA distribution form at the end of the year or at the beginning of the following year. Unfortunately, the custodian does not break out how much of your distribution was QCD and how much was just regular RMD or just regular distribution. You then, that's why I say you have to keep track, or you can, again, your custodian in your account history will have each of those checks numbered, and they'll also have, they have a history, a record of all distributions and transactions within your account for that calendar year. So that breakout between total distributions and which ones were QCDs comes when you fill out your tax return. So you just get they get it's a 1099, I guess it is actually, not a 5498. Maybe it's a 50. Anyway, that's the tax form that your client gets in February or so, and it'll just have a number. Okay, total distributions, $30,000. You then enter that number gets entered on your tax return, and then you and your accountant, your client's accountant, enter the amount that was QCD. And there's a little line right below that distribution number. That then gets subtracted, and you have the net number that gets reported as taxable income, adjusted gross income. Does that answer the question,
Jim,
I hope?
It does. And Jim, let me ask you this. In your practice as a wealth manager, for your clients who are in the age bracket, would you say that how did you approach your conversations with them? Did you, reach out to them, let's say sometime in October, and say, hey, start thinking about that. This is where you are at with your IRA.
Well, actually, our firm and our approach was we started talking about this in the spring. We don't want to wait till October. Once they've got their information about their IRA, which is their December 31st of the previous year value, and once they've gotten any kind of tax stuff for the previous year, then we would have a meeting, as I say, sometime in late spring, let's say. And now we're doing tax planning for the current year. And we're saying, okay, let's look at what you did last year. You filed your return now, or you're on extension. But anyway, we got enough information. So here's what we're looking at for the current year. Any major changes, big increase in income, decrease in income, big change in expenses, particularly deductible expenses, decrease. So we lay out as that, we say, okay, and almost every client, particularly of any income level, says, Jim, what can we do about my tax bill? What can we do about taxes? How can I reduce my tax bill? So again, depending on their age and their status, are they a business owner? Are they a W-2 employee? Are they under 70 and a half, over 70 and a half? So we would discuss the various strategies. And one of the strategies would be for those, obviously, of age qualification, 70 and a half or over. Hey, have you thought about a QCD? What's a QCD? So we would go through this, and at the same time, we're weaving in the discussion of charitable intent. So we're really discussing it from both perspectives. I mean, clearly, if a client has zero charitable intent, we're not going to force that on them, and we're not going to be the cause that they all of a sudden see the light. But many of our clients, not all, but many of our clients had some interest in charitable intent, particularly when paired with a tax advantage. Whether it's, like I said earlier, gifting appreciated securities, or even just writing checks to their church or their alma mater or whatever it is. So then I said, okay, let's work with this and see what's the most tax effective way to do your charitable giving to reach your philanthropic goals.
Fantastic. And we got another question from David in the chat. David is asking, what other special purpose or field of interest funds or other general funds available at EBCF that would qualify for a QCD? And David, we are preparing a communication about those funds that's going to come out sometime in October, where we let folks like what are the available funds at EBCF that can accept the QCD to make this more of a streamlined experience for both you And then at the same time allows our grant making team to pursue strategic philanthropic investments that we're doing in the community. Our colleague Shannon here on the call is responsible for putting that together. So you'll be hearing from us soon about that. But off the cuff, the easiest one that we always recommend folks to donate QCDs to are two funds. One is the EBCF General Operating Fund that allows us also to do grant making and keep doing the work that we're doing, offer webinars like this one. The other one is the Campaign for a Just East Bay, which is our strategic grant making tool at EBCF, where EBCF program staff work with a select number of nonprofit organizations working on specific goals for the year, and we make out grants to them through that fund. But all this will be in a communication to you in the following months. I want to open up or give the floor for one last round of questions if you have any pressing questions. Otherwise, we will wrap up and thank Jim and meet you next in the next session on October 9. Last call. All right, Jim, you've been crystal clear. Thank you so much for being here with us and going over this opportunity. And we look forward to talking to everybody on October 9. Thank you.
Thank you, Jim. Thanks for joining us, everybody.
Thank you. My pleasure.